Hi everyone! Welcome to part 5 of our Business Prosperity During a Pandemic webinar series. This webinar is part of a series of free webinars that Tax Forward will be offering on how to navigate through this environment. Welcome to those who are joining us for the first time, and welcome back to those who have joined us in our prior webinars. Let's begin with some housekeeping rules. We want to hear your questions. You can send us questions confidentially or to the group through the chat and Q&A features. I will read those questions as I see them. Polls will occasionally pop up during the webinar. This is both to engage attendees as well as for CPE certification purposes. Complete the polls to receive CPE certification. You'll receive a survey at the end of the webinar. The responses are anonymous. Please help us improve our webinars by completing the survey. The surveys will close Monday night at midnight. We'll email CPE certificates once the surveys are completed, and you'll receive more information about both in an email after the webinar. Summaries from our webinars will be posted on our site next week. If you hear or learn of something we should share with others, such as tools or guidance that is out there, please send an email to info@taxforward.org. Copies of the webinar will become available after the weekend. Let me introduce myself now. My name is Magnolia Movido, and I worked at the Big Four for about 16 years as part of the international tax and global compliance reporting practices there. I'm currently a counsel at Snell Wilmer, a full-service business law firm with more than 450 lawyers practicing in 15 locations throughout the US and in Mexico. And my practice here focuses on international tax law. I would like to thank our panelists for participating today in our webinar. Let me introduce them to you. Steve Barkmeier is the Director of Tax Services at Whipplewood CPAs, whose tax professionals include small business accountants who help with tax services, accounting services, bookkeeping services, assurance services, and more. Steve has 30 years of leadership experience in corporate tax departments at billion-dollar companies. He has extensive experience with tax planning and M&A for partnerships and corporations. Brandon Edwards is the CEO of Tax Credit Co., a company with more than 100 employees that provides tax incentive services and solutions. He has over 20 years of experience in the tax incentives area. Finally, we have David Milner, who is a Director of Operations for the West Region Property Tax Practice at DuCharme, McMillen and Associates Inc., a firm that offers business consulting services related to property tax, sales, franchise, medical device excise tax, and crown royalties. David has over 24 years of experience in the property tax field. So with that, we can start our program. I will start with Steve. Steve will be discussing various tax updates on COVID-19 from a federal tax perspective. Steve, you may proceed.
Thanks a lot. There are a number of federal programs set up to help particularly businesses through this crisis. The biggest one of these we found for our clients is the SBA 7A loan program, which you also hear referred to as the Paycheck Protection Program. These are loans based on a year's worth of average payroll, where you get the loan for 2.5 months of average payroll, and they're at least to some extent forgivable based on the spending that you have in the 8 weeks following that you get the time that you get the loan. There is also an employee retention credit that if you take the 7A loan program, you're ineligible for this particular credit, but it covers half of wages for each employee up to a $5,000 credit, and that's based on either your business being shut down due to the COVID, or that it has had a 50% reduction in its revenue. There is, in addition, a delay of employer FICA taxes, also including the 6.2% out of the self-employment tax. Those taxes get delayed on payments until 50% at the end of 2021, 50% at the end of 2022. That's another program where if you receive forgiveness on your 7A loan, you're no longer eligible for that deferment. Another big one that we found is the SBA disaster relief loans. These loans, it's an odd little quirk. You can have both that loan and an SBA 7A loan, but you have to apply for the disaster relief loan first. This particular loan includes a provision for receiving an advance on the loan. That advance then does not need to be paid back whether or not you receive the loan. The advance is up to $10,000, and if you receive the advance, the amount of the advance reduces the loan forgiveness that you have on the 7A loan. Next item is the qualified improvement property. They retroactively fixed the drafting error in the 2017 Act so that qualified improvement property is now eligible for bonus depreciation. In a lot of cases, people will want to amend prior year returns to claim that. In conjunction with that, they have also extended the carryback period of NOLs to a 5-year carryback period for NOLs generated in 2018, 19, and 20. And they have temporarily suspended the limitation that disallowed you offsetting 100% of your income with the NOL. So once again, there's a lot of people who can retroactively claim refunds by filing amended returns for those provisions. Another provision is for the few companies who have defined benefit plans, you can elect to defer any payments into those plans until January 1st, 2021. If you do so, then you have to provide for interest payments on those as well. The next item is they have liberalized the 163J interest limitations so that now you can increase the percentage limit on the 163J for interest to 50% from 30%. I think everybody's probably familiar by now, but income tax payments and returns originally due between April 15th and July 15th are now all extended to July 15th, 2020. And that's sort of a quick overview of the business provisions that we've seen people be able to take advantage of. And I know that Brandon has some more detail on some of those programs he'd like to go into.
Thank you so much, Steve. Thank you so much for providing us kind of like a high-level overview. And I would like to encourage the audience, I know there's a lot of information here. If there's any specific topic that that we talked about already that you are very curious about, you have some questions, please feel free to ask those questions anytime. And as soon as I grab those questions, I will go ahead and ask our panelists. As Steve said, Brandon has a few more words to say, and he will be discussing the employee retention credit and expectations about the updates on this. In the last 3 days, a lot of guidance and legislative intent releases have been made among Congress, Treasury, and the IRS, which seemingly conflict each other. I assume that there will be more guidance in the near future, but Brandon will talk about what the tax community should expect as far as how the conflicts will be resolved. In this regard, would you like to start it out, Brandon?
Hi, yes. Hopefully everyone can hear me. So thank you very much. The employee retention tax credit, I mean, even though it's been around less than a week now, it has gotten quite a lot of coverage. Again, as was mentioned, it can't be taken for a company that's taking the 7A Paycheck Protection Program loan or the payroll tax deferral, but it is important that companies evaluate which one they're going to choose with the best projections that they can come up with. There are a few factors. I am writing an article on that, and everyone keeps asking about which one to choose, and so stay tuned on that. It is a little bit complex, but as far as the variables. But here's kind of a brief overview of how the employee retention tax credit works. So first, you want to qualify the taxpayer itself. So was the company eligible? The company is going to be eligible if during the calendar quarter, and it really is a quarterly test on the entire taxpayer according to how the statute is written, did they meet one of two tests for the quarter? One is that the taxpayer and the whole controlled group was either partially or completely suspended based on some type of governmental order, and those orders are pretty flexible in the statute itself. So it can be shelter in place, it can be a complete kind of suspension like closing down, it can be just restrictions on travel, restrictions on group meetings, any type of governmental order that's restricting something. And so we're going to talk a little bit about interpretation on this, but any partial or complete suspension of the business makes the entire quarter eligible for the credit. Now, the second part is, how do you qualify the employee and their wages? And the employee, it's a 50% tax credit on the first $10,000 of wages and healthcare expenses for each employee that qualifies. And they qualify, it really depends on the size of your company. If you're most companies, I presume on this call, are over 100 employees. If you're over 100 employees, and that's determined based on mostly last year's employee size, but if you're over 100 employees, then you calculate the credit based on wages that are paid that are allocable to time spent not performing services. So in plain terms, if you pay people for not working, you get 50% up to the first $10,000 in tax credits. And we've seen this across the board. A lot of our clients, I'm very proud to be associated with a lot of companies. Some of them are paying 100,000 people, for not coming in because their restaurants or stores are shut down or only doing drive-through. And they're doing beautiful things to really help keep people paid, even though they don't need them. I think I've seen companies doing as much as they really can, and it's great to see. But this credit is meant to encourage that, and we have a lot of clients that are asking us now to run models so they can make good decisions and try to keep paying as much as they can to people that are not working. But that credit is for, if you're over 100 employees, it is for people that are not working and they're providing services. And we're going to talk for a few minutes about interpretation on that. There's a lot of activity happening between Treasury, Senate Finance Committee, IRS on that and the interpretation itself. And I'll go into some background on it and what you should expect. There are a few limitations on the calculation of the credit. One is that $10,000 limitation, which includes the wages that are qualified themselves, right? So you get 50% of that, and then any healthcare costs that's attributable to that period as well. And so one question that has come up is that you furloughed employees, for example, but you continue to pay their benefits. you could take a credit on 50% of those healthcare costs, which is pretty relevant for a lot of companies that couldn't afford to keep paying everyone's salary. The other limitation is called the 30-day prior limitation, which means that you can't boost the amount of wages in that period in order to get the government to pay it, half of it, and then lay people off. They limit the amount of qualified wages to what the 30-day trend would have been for that employee. And so you've got to calculate that, certainly, and make sure that you're limited by that. The way that you monetize the credit is through the payroll tax system, and this is unlike other tax incentive programs. On the federal level, there's one really about 10 years ago called the HIRE Act that did this, but most every other credit for business incentives is really below the line income tax based credit. This is a payroll tax credit, and that is really consistent with everything else in the stimulus package, that they're using the tax system to push liquidity through to the business community. And so the way you monetize the tax credit is by offsetting your payroll tax. Now, per the statute, it says it's really the employer side FICA that you would offset. However, in practice, in the regulation, you can offset all of your your employment taxes that you would owe otherwise to the federal government. So that would be both sides of employer and employee FICA, employer, employee Medicare, and federal income tax withholding. And anything else besides that any additional credit besides what you would owe is going to be promptly refunded to you. And the guidance that we're getting is within weeks that you'll get a check. And then for Q2, they're asking companies, there's a form, actually, the 7200 form, that's asking how much advance payment that you would be expecting and requesting from Treasury on that. And so that is not finalized yet. There's a draft form out, but that is that's available. Now, I should note that if you're under 100 employees, then the requirement that the employees are not working is removed. So if you're under 100 employees, that means if you continue to pay your employees and you have a partially or complete suspension of your business, that means you get the credit whether or not they're working, which is significant, obviously, for those under 100. Now, a few issues on interpretation. One of them is on the qualified taxpayer. This is getting a lot of attention right now, which means if for example, if you are a very large company, say for example you're Amazon, and Amazon, obviously they're hiring tons and tons of people right now. Their business is doing very well. They're increasing, their revenue, but they have stores, for example, that are shut down. They're retail stores that are shut down or have limited hours, for example. So those would be kind of qualified from that perspective. So the question is, do we determine Amazon as a partially suspended business? And based on kind of a plain reading of the tax code, of the statute, of the law, you would say yes. But there are a lot of questions on that, and since it's a wholesale issue, there are risks for companies as far as how they interpret it. We see it as pretty clear, and based on the legislative intent and kind of our contacts in DC that kind of were involved in the back and forth on the crafting of the legislation. We think that is qualified. However, we expect more guidance to be coming out soon. The second piece is really around qualified employees and wages, and this is where you're seeing a lot of action lately in the last few days. So on Monday, there were some announcemoses, some releases by Treasury, and then releases by IRS, and then there were releases by the Senate Finance Committee, and you'll see that Treasury has taken a very strict and draconian type of position with respect to the qualified wages, issuing a statement saying that you had to the employee had to be not have worked during the calendar quarter, which obviously doesn't really make sense because the whole legislation only came into effect for a partial part of the first calendar quarter. From the 13th of March on, doesn't really make sense.
Hi, Brandon. I think we lost you there. Okay, we'll give Brandon some time to get back. Oh, I think we literally lost him. I don't see him anymore. We'll give him a few minutes to jump back into the call. But I have a lot of questions for Brandon. But later we can go back to his topic, which is very interesting, and a lot of clients have been calling us about this employee retention credit as well. So with that, maybe we can turn it over right now, and we'll just go back to Brandon later to David. David, I know that today you're gonna talk about like a general overview as well as some updates regarding extensions and delays in both personal property filings and property tax bill payments. And you will also discuss assessment appeals and when the impact to the economy might translate to property tax relief. I'm very excited to hear about this topic on property tax. David?
Thank you. I appreciate the introduction, and you might be the one person excited to hear about property tax. But anyway, in all seriousness, there are three sort of aspects that drive the property tax annual process. That's when payments are due, that's when personal property filings or returns are due, and of course the appeal deadlines and hearings to correct any values that were overassessed in the taxpayer's opinion. We're not seeing a ton of reaction, to be quite honest, in property tax. We are monitoring all of the jurisdictions around the country. My firm is national, so I have counterparts in other regions, and we all contribute for our regions to a national sort of database, if you will, compiling all this ever-changing information. So on our homepage, you can find a link to that. And as I said, we do update that daily as counties change some of their positions. The most pressing matter is the property tax payments for, say, 2019, either first or second installments that are due in 2020. Some jurisdictions, for example, Denver County, they've gone ahead and immediately extended the payment deadline until April 20th. And anyone who was late as of March 20th would receive a waive of any penalties or interest to pay by April 20th. But a lot of the other counties in Colorado, pretty much every other county, hasn't extended any deadlines yet. So it really is emphasizing the state and local nature of property tax, where you're seeing even within the same state, again, under the same Department of Revenue, different counties taking different opportunities to, I guess, impact their taxpayers as they see fit. Likewise, with personal property filings, for example, we just saw that El Paso County yesterday extended the rendition filing deadline from April 15th all the way to August 1st. Eagle County, I believe today, just said they're also working to extend the April 15th deadline. But again, we haven't seen a lot from Denver or some of the other metro counties. And so, again, in Arizona, yesterday was the deadline and there were no extensions. Now, they will grant an extension as they would under normal circumstances if it's requested. But some of these counties and states are just seeing this process of reporting for last year kind of as business as usual. And that's a good time to bring up the way property tax is considered. Obviously, there's a lien date, which in most of our Western states and most states around the country is January 1st. And of course, it's a historical tax. So we're going to look at what the prior year's period looked like as of 1/1. So all of this activity that's negatively affecting pretty much every kind of business except maybe grocery stores, all of this activity really won't be evident in the financials of these businesses until the 12/31 year end. And that, of course, precedes then that next January 1st lien date, where, for example, on a real estate appeal, you'd be able to support your income and expense data, where we would assume the net income is going to be significantly altered due to closures and obviously reduced spending and everything else we read about. And so with property tax, we're really expecting the lien date to start driving the relief next year. And usually property tax is a year to 2 years behind. We saw this in the Great Recession as well, because obviously assessors generally reduce values based on income and comparable sales. And so at this point, the assessor can still point to comparable sales that are very different than what the market presents today or for the last few weeks. And so until those sales become aged out, unfortunately, That's kind of the way property tax is assessed, is based on what the evidence supports. So while we don't see as much immediate relief for these tax considerations for property tax, they generally will go further into the recovery as well. Because obviously properties, let's say a retail property sells distressed in November of this year, that sale is going to be valid for 2 years going forward. And so as late as into the spring of 2022, we may be able to point to that distressed property sale. So obviously by 2022, hopefully we're all on the upswing of the V or the U-shaped recovery that we've been hearing about. And so then instead of getting that initial relief from the property tax perspective, as we're saying some of these other tax types, you would still be seeing some relief due to the duration of the property tax evidence being supportable. So that's, I guess, in a nutshell, how we see some of the general impairments and impacts. One thing I will say is there are a few different jurisdictions, like some of the California jurisdictions have natural disaster relief. And so in states where the governor has declared a state of emergency, for example, in California, where the federal government has acknowledged, if it is a obviously official pandemic, it oftentimes might qualify in that natural disaster relief consideration, in which case, for some markets this year, we may be able to actually argue for relief on the current assessment appeal. Now, having said that, we've also seen mass delays in hearings. Some states like California generally runs 2 to 3 years behind in hearings anyway. So if we were filing for relief due to the COVID-19 pandemic today, we probably wouldn't even have that hearing until about 2022. But the hearings that we had scheduled for clients and for taxpayers from, say, the 2018, 2019 tax range, those hearings that were scheduled for this time are being postponed. And California, we've seen postponements as late as into September. So obviously, we don't know exactly what all the state and local guidance is going to suggest. Our firm's guidance is to always pay your property taxes timely whenever possible. Even if you're going to protest, you should pay under protest according to the statutes and the state guidelines to avoid any sort of lien or risk to your property. Obviously, these are extraordinary times, and so certainly I'm sure jurisdictions as well as we understand that taxpayers may be forced into compromised positions. But our advice to clients is to always pay your tax timely, proceed with the appeal process, and then obviously await the refund or the reduction in the tax bill depending on what the circumstances are. But in a nutshell, that's how we're looking at property tax. And so again, we believe that 1/1/21 lien date is when a lot of the taxpayers should begin to expect some of that relief.
Thank you. Thank you so much, David. As I said, I was excited to hear from you because I know the updates on this topic has been slow, as you noted. And so it's very good to learn more now what's going on. And we hope that we continue to hear more from you in our next series. I think that Brandon came back on. So if that's okay, Brandon, would you kindly proceed with, I think you kind of got cut off there. If you could kindly continue with what you were discussing, and then once you're done, I think there was a question that I saw with respect to what you were talking about. So let's go back to you, Brandon. If you can hear me, you're online again.
Sure, I'm here. Thanks so much. Thanks for that information also on the property tax. The issue that's happening right now is that the Treasury came out with a very restrictive definition of which wages qualify, and it is not supported at all by the law itself as it was written. The law as it's written seems extremely flexible and allows taxpayers, as is kind of consistent with a lot of other tax incentive programs throughout the last 30 years, is that it provides sufficient flexibility for a taxpayer to determine which wages are actually attributable to the time an employee spent not working. That's what the Senate Finance Committee released, was an FAQ that was also on Monday, where they released an FAQ that really, on a very detailed basis, for the first time we saw them describe scenarios such as a reduced pay situation where someone is working, say, a half schedule, getting paid for all their time and their usual, full-time pay, but working on a reduced schedule. And the Senate Finance Committee even uses language that supports the interpretation that you can consider what they would have been paid if they had worked that reduced schedule as compared to the full pay that they're receiving. And so the Senate Finance Committee information is not anything that can be used to rely on, and it disclaims that. However, it does demonstrate the legislative intent. And so, Senator Grassley's, group, and then Secretary Mnuchin's group kind of, I guess, had different interpretations. And then you saw the IRS on the same day issue two different publications. One was on their website, one was an FAQ about the program, and the other one was a newswire announcement that was some information about it. And the FAQ was really reflecting language that was consistent with the Senate Finance Committee version, and the newswire release was reflecting language that was basically verbatim repeating the Treasury Department's announcement. So very confusing for everybody. The good news is for taxpayers is that the law wins because the Treasury's job and IRS, of course, works for the Treasury, is to interpret the law and follow the law. And so the intent of the legislation, the plain meaning of the language of the legislation, is what should override all of this. And so from a tax administration and compliance perspective, you don't want a situation where where you need to debate with the IRS over what the law is. That's extremely inefficient and creates risk for taxpayers. And so we've been working on this, but as I had actually, as we had expected, there is a resolution coming. We already understand that Treasury is going to edit what their interpretation to follow the Senate Finance Committee's interpretation of that. And so that's good news for taxpayers, and hopefully there's going to be some additional guidance that will come out to make that more clear. And I think all companies should really analyze this, because there's going to be more and more opportunity with the employee retention tax credit because of this, because most companies will have this situation, many different situations, whether or not it was kind of deliberate pay for people not working. Oftentimes you will find many pockets of situations where there is pay, either what we would call partial pay for a partial work performed for full pay in a period, or even more than that. So that's what's happening on the legislative side, and the regulatory side with the employer retention tax credit. Another thing that, if you have kind of a lot of tax people on the phone here, there's a problem with the statute that we saw, which is they apply what's called the 280C election. There's a principle in tax credits that really applies to income tax credits, where you're not allowed to take a deduction and a credit on the same expense. And so, typically speaking, if you're looking with the R&D credit, the work opportunity tax credit, which et cetera, you would back out the expense deduction that you took for the wages or costs that you're using, that you're claiming as a credit, and replace it with a credit. And so that means that, today you're getting 79 cents on the dollar for a credit. Well, it references 280C in the statute itself. It references this, and however, it doesn't really make sense, because the credit that you're getting is a payroll tax credit, which is already, by not paying your payroll tax, you are already you're already achieving the objective of not taking a deduction and a credit on the same expense. And because your taxable income is going to increase to the extent that you take the credit by definition. And so there are a few interpretations. There's actually only two interpretations that we could come up with of why this is in there. One is to kind of prevent abuse of the situation, with a more aggressive interpretation. But the other is that it's just a mistake. Either way, we're looking for guidance on this, and we hope to have that for our clients shortly. And
Thank you so much.
My pleasure.
Thank you so much, Brandon. Actually, what you stated a while ago with respect to non-reliance, I was in another webinar today with American Bar Association tax section, and Michael Desmond, the chief counsel of the IRS, was there, and he kind of said the same thing, because I think there was a question from the attorneys whether they can rely on, or the clients can rely on, some of these guidances that were issued, and he was saying that no, it's not. That's not going to happen. We're not going to do. The clients cannot rely. However, as you mentioned, what we expect is there will be more guidances that will be issued in the future. Hopefully, will clarify all of these conflicts. I myself, I'm following all of these developments when these FAQs were released on March 31st, and you see them, you see all of these, comparing it with the legislation. It doesn't tie up very well, so hopefully we'll get to see some of those clarifications in the near future. I think I saw a question that was asked a while ago by one of our audience. He asks, did I hear correctly that on the deferment of paying payroll taxes to 2021 and 2022, that interest will be assessed to the taxpayer? Brandon?
No, that's not correct. There's no interest. It's a free loan. You get to not pay your employer side FICA through the end of 2020. You pay 50% of it in the 12/31/2021, and 50% of it 12/31/2022.
Thank you.
This is Steve. I think the confusion on that may have been that if you defer payments on your qualified deferred, or your qualified plans for the defined benefit plans, then those contributions later that you make to the plans do need to include interest. But that's just basically on traditional pension plans.
All right. Well, thank you, Steve, for that additional input. And speaking of this employee retention credit, one of the things I was thinking about, since this credit, basically, if the employers are receiving emergency SBA loans under the Paycheck Protection Program, they are not eligible for this credit, and they cannot also receive both the SBA loan under the Payroll Protection Program and this employee retention credit. So it's almost like, you have to kind of pick and choose, which one you're going to take if you're an employer. And the problem, as you noted, Brandon, a while ago, this is on a calendar quarter basis. So when you hit that significant reduction in gross receipts, right, it's on you look at it from a calendar quarter perspective, and therefore, you cannot really predict, what it's gonna look like in the third or fourth quarters, right? Do you go with the other incentives or disincentives? So that's another thing that I'm seeing here with this employee retention credit. Any other? I don't see any more questions so far that has been given to us. Anything else that we have not touched on with respect to either of the three topics? I know, Steve, you talked about the federal aspect, David, the property, and Brandon, you talked about the employee retention credit. Were there any other topics that we need to cover as of today?
Well, I think I didn't mention that second test that you just referred to about the employee retention tax credit as far as eligibility. We talked about suspension of operations, and partial or complete suspension of operations due to governmental order. The other that you mentioned is if you did not have such a suspension, but you did have a 50% decline in gross receipts from on a quarter-to-quarter basis for the prior year's same quarter versus this year's quarter, then you would also be eligible in that quarter. So that's a good, definitely good to point out.
Thank you, Brandon. Anything else, Steve or David?
Nothing for David, thank you.
Yeah, I don't think I have anything else unless somebody has specific questions about some of the programs that I sort of ran through at the beginning.
All right, let's give everyone maybe a minute or so to give their questions, if any. I think it's a lot to digest for sure. I mean, the CARES Act is just like, it's so big, and of course we're seeing a lot of issuances here and there from different places, and so I hope that everyone is also aware that there's a coronavirus webpage within the IRS website. It's been very helpful for me in my practice, you know, being able to actually follow all of the new issuances. It's irs.gov/coronavirus, I believe is the website, and if you take a look into that, you'd be able to find you know, new guidance, basically on a daily basis. I think, let me see. Oh, I see another one. Were the charitable contribution items covered or R&D from? Oh, this is a question for me, not for the speakers, but yeah, do we have any sort of information on charitable contributions at all from any of our panelists?
That would not be me about the charitable contributions. Steve?
Nothing? Okay, just wanted to make sure that you know, I asked that question in case anyone would like to speak on that. Anyhow, I don't see any other questions so far, so maybe with that we can wrap up. Ashley, were you saying something? Okay, yeah. Go ahead.
Are you able to hear me?
Yes, we can hear you now.
So I wonder if we might have lost Steve. So the charitable contributions, that's in regards to a lot of the conversions that's going on. For example, companies that are converting from sit-down restaurants to being a like a food hall, or forgot what it's called, but you know, they're offering free food services, eating food to the hospitals, and manufacturers who are converting. For example, Minnesota, there's a flag manufacturer that has converted some of their production to making masks, and they're donating the masks to hospitals. And so the question there is, how is that treated? So there are special rules that pertain to the donation of food, and there's special rules that pertain to the donation of goods, depending on where there are in your supply chain. And so we're hoping that Steve might be able to address that, but we want everybody to be aware of the fact that if you are donating product to, or supplies or inventory to hospitals, or you know, to a nonprofit, to keep in mind that there are special rules and benefits that come with making those donations. And so they might also, in addition to that, need to record specific information that relates to that. And then in addition to that, due to the conversions, there's some R&D aspects as well. So maybe not so much in terms of the donations, but where the products are being sold. So for example, I think a lot of us are aware of the auto makers who are converting some of their manufacturing lines into manufacturing of ventilators and other hospital equipment. Brandon, is that something that you might be able to touch on lightly?
This is Steve. I'm still here and I can address that. So I have not seen anything new come out on contributions of inventory. So I think that still falls under the traditional rules where a charitable contribution is available, but it's based on the tax basis of the particular items, not necessarily on the fair market value that you might see of a capital asset.
Okay, thank you. Brandon, how about you? Is there anything that you might want to advise people in regards to R&D and the conversion of the manufacturing lines?
Yeah, so with respect to that, certainly there are a lot of opportunities for companies on the R&D tax credit, and that's an area, obviously, that's an area where you can get immediate cash benefits. If it's not, even though you don't file your tax return in the next year, you can certainly take into account your estimated tax payments when you, when calculating the R&D credit, so you can get a more immediate benefit. The R&D credit applies to any type of improvements to the business, so new processes, products, or software where there was uncertainty at the outset. And so typically speaking, that is really any type of new product, process, or software, and it's not a question of if. Most of the time, it's a question of just how much of the expenses that are involved qualify. And so when you talk about a Tesla or a 3M or apparel companies kind of switching to try to support the medical device and apparel and protection gear needs and changing production lines, all the wages that are involved and the material costs involved in creating prototypes, and also all the consumables and labor that's involved in running trial production runs until you get the product to full production, normal production capability. All of that time and cost is part of the calculation of the R&D tax credit. And so that certainly would be a tax benefit that's always there, that would be relevant to what's happening today. And I should note also, sorry on that there's a California tax credit, and most other states have a tax credit that is that matches the federal tax credit. And there's a new recent safe harbor provision on the tax credit for companies that reflect their R&D expenses on their audited financials, whether they're a public company, not a public company. That is also followed by several states, including Minnesota and California, and that I would highly recommend. We've had very good experience with that, even though it's relatively new.
Awesome. Thank you so much, Brandon, for that. And I would like to acknowledge that we got 2 more questions from our audience. Thank you so much for those that sent their questions. And I'm going to go ahead and read one of them. So the question goes, doesn't the California Disaster Relief under CARTC 170 provide that if a calamity such as fire, earthquake, or flooding damages or destroys your property, you may be eligible for property tax relief only on the improvements? COVID-19 is an economic obsolescence position, and shouldn't it be applied through Prop 8 appeal? While it is post-1/120, compassion could be applied by some jurisdictions, but isn't this really an issue that assessors will have to consider starting in 2021? So I guess this is a question for David.
Yes, and that's kind of exactly what I was alluding to earlier during my portion. A couple of states, because of the wildfires, have recently called on some of this natural disaster relief. So in some of the Midwest states as well, we've also seen some cases where the pandemic in a state declared emergency that's acknowledged by the federal government, we could see that compassion is applied this year. So California is one of the states that in 2020 appeals, because they're going to be so late in the year, September and November, definitely would recommend giving that a try. And of course, especially in 21, when, as we said, the financials should actually reflect what has happened as well.
Thank you, David. Hopefully answers the question. If there's a follow-up question on that, please send them in. And then the second question that I saw here, if the company is 30% owned by a foreign entity, but all employees are U.S. citizens, is relief available? So I think that can be answered by any of our panelists.
I believe
I
that
think that the company is a domestic company here, but it wasn't stated so.
Yeah, I think that the answer to that is yes. I didn't see anything in the legislation that would limit any of the tax benefits from a U.S. company because of foreign ownership.
I would agree with that, Steve. I haven't seen it myself. David or Brandon, any comment?
No, I'm not aware on that.
Yeah, me either.
So I have seen some limitations regarding ownership, but I'm not aware of what the percentages are. So what we can do is, if there is anything that we find that disagrees with what you've said, Steve, or anything that builds upon the information that you've provided, we can add that to our website.
We can certainly research that if needed. You can contact us.
Great, thank you, Brandon.
All right, I don't see any more questions, just making sure I'm scrolling through everything here. Okay, I think that's it. I don't see any more.
And
so,
I would just mention, by the way,
Brandon?
I would just mention that 30% ownership of a foreign entity doesn't seem to be like it would be a problem for the user. I haven't seen anything to the contrary, by the way. Yeah.
Agreed, Brandon. But we can research on that as well. But I haven't myself seen something like that as well. So let's see. I see that there's no other question for now. I think we're done with our polling questions too. There were 5 questions. I hope you were able to see all the answers to the polling questions. Again, thank you so much for everyone for participating in our webinar. We'll just have to bring this discussion now to a close. To our audience members, if you have additional questions, please send them to info@taxforward.org.